Hedging is no longer a topic reserved for trading floors or treasury department. For businesses across metals and recycling value chain, price volatility has become an everyday reality that can make or break margins. Welcome to Sustainability Café, the podcast channel from Waste and Recycling magazine, and I am Kirtana. On this episode, we are diving deep into hedging, a topic that remains one of the least understood tools in the corporate toolkit, and in today's environment, it may be one of the most important. To unpack it in plain practical terms, we are joined by David Micallef, speaking to us from the StoneX studio in London. Known to the industry as Fox, David is co-head of the base metals corporate sales and trading for EMEA at StoneX Group, one of the world's leading financial services network. He works with corporates, producers, and consumers across the globe, helping them navigate price risk and structure hedging strategies. Fox, wonderful to have you with us today, and we look forward to your insights on hedging and its role in protecting businesses in today's unpredictable markets.
My name is David Micallef and I'm co-head of the EMEA division of the base metals department over at StoneX. My background is 99% LME. I've been working in the London Metal Exchange industry since '95, so I think I'm up to 31 years.
Before we get into the detail, for someone in the metals business who hasn't come across StoneX before, who are you and what do you do?
So StoneX are a Fortune 50 company, originally incorporated in 1924 in the US, heavily into the cotton industry, the cotton hedging, commodity hedging business. Globally, we've got about 54,000 commercial customers. Our retail team have in excess of 260,000 customers, and we provide hedging, trading, execution, clearing services across almost every commodity and almost every exchange that there is. The base metals team of StoneX are one of only 8 brokers on the LME floor itself and one of the last remaining Category 1 clearing members.
StoneX has an interesting origin story and a long history. It would have witnessed commodity booms, busts, wars, recessions, and market crises. What does that kind of institutional memory actually mean in practice? Does it change how you advise clients today?
Well, since our inception in 1924, I think we ended up joining the Chicago Mercantile Exchange in 1938. We've had over 100 years of financial experience. We've seen, like you say, every boom, bust, war, and everything else in between. So we're very, very well versed in how the world works. So on the base metal side itself, we've got over 150 years of collective trading experience. And that means that we can tailor our offering to customers. It means that we can really look down at the detail of what they're trying to trade and how they're trying to trade it.
If a metals company told you we have never hedged before, where do we even start? What's the very first thing you tell them?
I would say think of hedging as a form of price insurance. I mean, you insure your facilities, you insure your stock, you insure your warehouse. Hedging itself is just to protect yourself against some violent movements in the underlying price. It's definitely something that every company should be looking at and something that every company should be at least aware of.
A lot of professionals deal with LME prices every day but have never actually placed a hedge. What does the process actually look like?
So a lot of companies will see and a lot of customers will see the LME as just the 1 o'clock price, the price that they're published, that they're delivering their physical material. The other side of the LME is the intraday trading. It's up and down all day long. So you have to think of the LME as the ability to provide a paper trade. You're not trading physical with the London Metal Exchange, you're trading a financial future against it. The theory is that what you do on your physical, you do the opposite on the financial. So a customer will have their physical exposure, the LME has the ability to offer a paper exposure, a financial exposure. For example, if a customer's got 100 tonnes of copper in the yard, the price of the underlying asset is moving up and down constantly. By trading a hedge on the London Metal Exchange, he can mitigate his risk against those price movements. You're not trying to beat the market, you're trying to lock in your margins.
How does hedging on the LME differ from other commodities?
The London Metal Exchange has a slightly strange way of looking at the market. We trade per date, as in most commodities, if you're trading oil futures or energy products, you trade on a monthly basis. In the LME, you can trade that down to an individual prompt date, one delivery date that you can specify in the future. So you're not held to just a monthly average.
One of the least talked about decisions is how much to hedge, the hedging ratio. How should one arrive at that number? Is it science, judgment, or both?
It's completely down to a customer's individual risk profile. You know, how much risk do they want to take? A customer may hedge 100% of their production, they may hedge 50. It's very, very individual to the customer. The upside of the hedging facilities that we have is that you can really tailor it down to exactly what risk you want to take for the firm.
What does disciplined hedging look like in real-world practice, and what advantages do companies that stayed committed to it gain over those that didn't?
Well, hedging needs to have a framework. Every customer has to have a strategy in place that they stick to. The whole idea that this is a long-term play to protect your margins going forward. It's not about short-term profits. So as long as you stick to what the game plan is, you've got your finances in place and you know your entry and your exit strategies. So there needs to be a very clear framework for each customer. They have to have a hedging strategy in place that they're going to stick to. It's not about short-term profits, it's not about short-term gains, it's about long-term risk management. Using the hedging facilities available to manage and properly calculate your cash flow going forward. That's the game plan, really.
Without getting too technical, how do you explain to a business owner the difference between locking in a price with a futures contract versus buying an option?
Options are becoming more popular with experienced traders, but they're by no means foolproof. Buying an option costs money, the cash flow implication is sometimes higher than an underlying future, and the profit and loss effects are a little bit more technical to work out. A vanilla future where if the price drops and you're short, you're going to make money is very, very straightforward, and especially for new hedgers would be a preferred way of looking into mitigating their risk. The more comfortable a company gets with trading the markets, the more comfortable they are with looking at how prices affect their option strategy, the more they should get involved. But there are added complications with options. But for those that do have long-term views, for those that have much more volume, options are definitely a good way to look at mitigating their risk.
What are the most common mistakes companies make when they start hedging, especially mid-sized manufacturers or recyclers?
The two things I would say is one, assuming that every hedge will make money. It's just not how it works. The whole idea of a hedge is exactly that. It's there to mitigate your risk. The principle being if you make on the physical, you'll potentially lose on the hedge. So once a company understands that as a concept, they're good. The other one is the cash flow. You know, hedges on any market will cost money. There's initial margins, forward profits and losses. We're very, very happy to sit down with people and work out what these cash flow implications are, but as long as customers have those two concepts in their head, they'll be okay.
For recyclers and scrap-based businesses, how does hedging differ compared to primary metal producers?
The principal difference between a recycler and a producer is what side of the coin, is where their risk is. So if you're a recycling facility, you've got material in the yard, your biggest problem is if the price drops. To mitigate that risk, you'll put a short future in to try and hedge against a price drop. If you're a producer, you've already agreed to make delivery on this material. So if the price goes up, the cost of your raw material becomes more. Therefore, you can do a hedge the opposite way around. They are literally two sides of the same coin.
Can hedging ever make a situation worse?
Sharp one-directional movements in the market will always cause stress. Long-term hedging is just that, long-term hedging, but again, it's all about cash flow. So if we see, like we have done recently, violent movements in the underlying price where there's a one-direction movement for an extended period of time, it will affect customers' cash flow. At the end of the day, yes, they'll make money on their physical material, but until that point of delivery and that cash has come into the building, there will be a stretch on where they are. That's probably the worst case scenario we can see on the hedging.
We are living through a period of extraordinary uncertainty. Some would argue that in this kind of environment, hedging is more important than ever. Others say the volatility makes it almost impossible to hedge effectively. Where do you stand? And for a metals company sitting on the fence right now, what's your message?
My message would definitely be to look at every hedging scenario available on any of your underlying assets, be it the metals price if you're a recycling yard, be it an energy cost if you're an actual producer. There is a price mitigation for every underlying commodity, and the option of going and looking into a strategy has to be explored if you want to sustain your cash flow going forward.
What are the top 3 reasons why businesses do not hedge?
The first one really is cost and short-term P&L pressure. You're going to have to put down initial margin to put a hedge on initially, and if it goes against you, there will be a mark to market. Lots of companies are put off by that, but as part of a long-term hedging strategy, it has to be the way forward. The second one is a belief that they can time the market correctly. Lots of customers will sit on the side and they say that the market is circular, the price always goes up, the price always goes down. It doesn't work that way. You know, as we've seen recently, there's massive spikes that can go for long-term periods. It doesn't always come back to the same place. And then the last one will probably be the operational complexity. Yes, you do need to know about the markets, but there's a lot more education, there's a lot more knowledge around than before. It's much more transparent. So I would definitely encourage customers to go and get the knowledge, speak to their brokers, and try and look at what hedging strategy works.
Metals are priced in dollars, but most Asian producers operate in local currencies. How do you structure a hedge with both commodity and FX risk?
With the growing use of OTC products, we can actually tailor down to a customer's individual need. So we can use a combination of outright futures, forward averaging, foreign exchange trading to get a real strategic hedge in place that mitigates your risk against your actual contractual obligations.
Fox, thank you so much. This has been incredibly insightful. For our listeners, if this episode got you thinking about how you manage price risk in your business, that was exactly the point. Until next time, this is Sustainability Café from Waste and Recycling Magazine. Take care.